What is going on, guys? It's Edward with Crypto University, and today I'm going to be talking to you about volume and liquidity. So I'm going to be using a couple different coin pairs for examples here today. First one we're going to be taking note of is Bitcoin. Bitcoin has a nice chart where you can actually make sense of the candlesticks if you know how to read candlesticks. If not, just keep going on with this course and you'll figure that all out in the technical analysis section. But we're just going to be observing some differences in volume action and candlesticks, how it reflects in the candlesticks. So an exchange that has a lot of volume, everyone might be familiar with Binance. So right now we're looking at Bitcoin USDT on the Binance exchange, and we're looking at the 1 hour time frame. So these candlesticks here carry a lot of information, and you can actually analyze them to make predictions for your technical analysis. Now, don't mind any of the zones that we have drawn in here. We got a couple different maps for Bitcoin, so it might not make sense right now, but like I said, later on when you get into the technical analysis section, you'll start to understand more of this as it goes on. We just want to talk a little bit about volume and liquidity. So Bitcoin obviously has a lot of trading volume. Its market cap dominance at the time of this video recording was about 40%, which means its total trading volume is 40% of all of the coins in existence, right? So the entire market cap of cryptocurrency is around about 2 trillion. 40% of that belongs to Bitcoin. That being said, there's a lot of trading volume within Bitcoin. So you have a lot of opportunities to make trades within a pair that has more volume. Have you ever seen a chart that looks something like this? This is what we would call a low liquid pair. So on the hourly, these candlesticks look a little bit different, right? They don't look like your basic candlesticks. It's because there's a lot of price action within them because there is such little volume. So there's a difference in the amount of volume flowing through this pair than there is Bitcoin USDT. This is POA BTC. This pair has less trading volume, so it has a greater chance of being manipulated. Now, planning out a trade on a pair like this wouldn't be impossible. If you look down into the bigger time frames, you can make sense of some of the data out there. Like, see, those candlesticks don't exactly seem hard to analyze. You can see here there was a big jump in price, and then it was rejected, coming back down, but still forming a steady uptrend. And you can see that reflected in the volume below, right? So as there is a pump in volume, there's a pump in price. Now there's a decrease in volume, decrease in price. So you can see how volume correlates directly, right? Now, if you try to take advantage of this pair on the 1 minute time frame and zoom into it, you'll find that it's not going to make a lot of sense. You're going to be trading the wavelengths almost because this coin pair doesn't have a lot of volume to it, right? So it's not like people are dumping millions into this and you can get a lot of price movement out of it in a short amount of time. Now, if we change this over to Bitcoin, come back up to our great Bitcoin, you can see these 1 minute candlesticks make a lot more sense, right? There's a lot more information being carried here, and you can even see measuring here is reasonably stable, right? As more volume comes into a pair, it becomes harder to manipulate. So since a lot of people are trading Bitcoin, now don't get me wrong, every pair is going to have some sort of market manipulation, whether it be from holders, investors, outside resources, influencers, or manipulators. It's going to have some type of manipulation. And that's just every kind of market that there is to exist, right? You got to think about the guys that got in on Bitcoin when it was really cheap, when the liquidity was not there, right? So now these holders are providing liquidity to the exchange because they're hanging on to their coins and giving us the opportunity to trade. So trading a coin pair that has more volume is safer for you to trade. Trading something like the coin pair we were observing before, if you dump all your money into it and it moves significantly, you can take your price out in a reasonably short amount of time, right? But those coins also have a likelihood of dumping significantly, meaning that you might not ever see your investment come back to the price that it once was. So definitely, whenever you are learning to trade cryptocurrency, you want to choose voluminous pairs with lots of liquidity. So you can go to CoinGecko.com and see the trading volume over the past 24 hours. You can actually sort by trading volume. So you can see which pairs had the most trading volume for you to find opportunities in and which pairs had the least trading volume for you to avoid. Now, just because it has a little amount of trading volume doesn't always mean it's going to be a poo-poo coin, but Generally speaking, you will have more safety and more opportunity and more chance of correcting an issue if one arises if you are trading in a pair that has a lot of trading volume. Like say for today, for example, Ethereum is very highly traded. There's a lot of trading volume within the last 24 hours. And Bitcoin is also highly traded today. There's a lot of trading volume in the past 24 hours. So those two coins would have given you the best opportunities to make profits and correct any mistakes that could have been made. For example, if you are watching Bitcoin's price and you make a trade, right, and it goes down 10%, that's okay. You don't have to worry too much because Bitcoin's a quality coin. It's going to increase in value over time and your mistake will be forgiven, right? You'll see those profits come back. But if you're trading a poo-poo coin, something that doesn't have any trading volume, something that just came to the market or something that's brand new, your coin can deviate, minus 10, 15, 20% and never return to those prices where you invested. Or it might take a substantial amount of time to get back there if it ever does. I know some people who invested in a coin called IOTA in 2017 and bought at the wrong time. They had to wait for years to see their investments come back, and some of them sold for a loss because they had paper hands and don't know how to hold. And we've seen this happen recently with Dogecoin as well. Dogecoin had a tremendous run up all the way to 70 cents and then came back down, right? Even though there was a lot of trading volume in that coin pair, it still dumped on a lot of people, and that was noticed in the trading volume. You could actually see that when you were looking at it on the chart. So this is a brief overview of Dogecoin, and as you can see, as the volume increases, so does the price. As the volume decreases, the price starts to decrease too. Then the volume has a big candle here, and as you can see, directly related again, the volume decreases. So as we have decreasing volume, then we have these spikes in volume, which can signal a trend reversal. And then again, here we see as volume increases, so does price. When volume starts to decrease, so does price. Then we have here volume's cupping up, comes up again, so does price. Volume starts to leave the trading pair, the price starts to depreciate. So that's how you can correlate volume to trading. The more volume a trading pair has, the higher probability your chances of being profitable are. So I hope that video was helpful, and thanks for watching.